question is, if debt is dangerous, why do banks keep lending billions of dollars to real estate investors every year? There's something about real estate investors that banks really like, and they love us, right?
Yes.
So let's jump into this.
So,
Yeah, welcome to REI 101. Today's going to be a great episode. We are beginning our debt and leverage series. So we're going to be talking about debt. It's a lot of people. It's just another four-letter word. And if you were on the call
a
last
four-letter
week,
word that begins with D that nobody,
yeah, it's the worst one, right?
the worst one.
No, it doesn't have to be. Debt is not good or bad. We're going to talk
Yeah.
about that today. But if you're on the call today and I say debt, when you hear the word debt, what do you think? What comes to mind when you hear the word debt? Is that a good thing, bad thing? What do you hear?
I mean, I don't know. I used to be nervous when I heard the word debt. I used to be anxious when I had debt, when I had consumer debt and things like that. So, but now, debt used the right way, I'm okay with it. Now, when I hear about debt, I'm like, okay, cool, not a biggie, you know.
Not it. So how has, you've been an adult for a couple of minutes. As you became, and I have two daughters right now. They're going into the workforce and graduating college, and they're going into stuff like we graduate and debt. For me, debt was just like that's just a part of like life. You know,
Hmm.
what what was your perspective when you first went into adulthood, and how did that change? Like, how did that change over time?
I mean, when I went into adulthood, I mean, and credit card companies still do this, Austin, is as soon as you graduate from high school, you start getting all of these credit card applications in the mail. And for me, I didn't have a really good example, like role models of how to use money appropriately growing up. And so when I got these credit card applications, I was thinking, cool, free money,
Hmm.
And I had a little job sacking groceries at the Albertsons in College Station, and my mom was sending me, $100, 150 bucks a month, and I was on a scholarship. But again, when I was that young, I was thinking debt was free money, and it
Hmm.
wasn't, obviously. It has to be paid back with interest. So I got into small amounts of debt, just dumb stuff, Austin, magazine subscriptions. I don't know if you remember the Columbia House Music Club. Like I owed them like, I don't know, $35 or something forever. Like it was crazy. As I got
I
older
remember the
though,
commercials. Yeah.
yeah, 10 cassettes for 1 penny. And you had to tape the penny to your choices. That's how old it was. Anyway, as I got older, still didn't really have a good relationship with money. It wasn't really until I met my wife, Julia, where, or actually, let me backtrack. It wasn't until I went through my divorce
Hmm.
where I was really kind of forced. Okay, now you've got these additional financial obligations, and you have your own personal financial obligations as well. So you got these two households now you have to support, which was
Hmm.
fine, great. And I had to manage my debt because if I didn't, I saw my kids as suffering if I didn't handle debt properly you know. So I just started to pay things off. When Julia and I got married, we combined everything, and then you know what it's like. Like we were more than the sum of the two together. We were more, and we went through the Dave Ramsey
Yeah.
baby steps, paid off all of our debt, funded our kids' education, and really only had our mortgage. Even our cars were paid off. Just had our mortgage, and then we started investing in real estate. And then we
Yeah.
kind of really, really strayed from the Dave Ramsey, like debt is done, dumb, like cash is king thing. And we
Yeah.
really learned how to leverage debt the proper way to build our real estate portfolio.
So is your story is very interesting. It's very similar to mine
Mhm.
because, I graduated in 2000. Um, I maxed out the first credit card I had like that because I was like, oh, credit card. I got pre-approved, felt like a pretty big deal. I'm just gonna hold this in case of emergencies, and yeah, emergency happened 5 minutes later, and it was maxed out. So, um, I was in a similar situation. We suffered for a few years, and I got tired of being broke. I got tired of, not being able to pay all my bills on time. And I had all these credit cards and I couldn't use them because they were maxed out. And same thing, Dave Ramsey and everything made perfect common sense. And, um, I started doing the math.
Hmm.
I've told you my first wife she bought a vehicle, and I think it was like 18 or 20,000. It wasn't really expensive, maybe 24,000 something at that time. And I said, "What is your note?" And the note was like ridiculous, like 500 a month over 60 months. And I'm like, "Did you multiply it? Like your 500 times 60 is not 20,000. It's like 30 or 1,000." And it was probably more than that as well. Like you're going to be paying more than 50% of the value of this vehicle in interest.
Yeah.
In a lot of cases, it's more than that. So, yeah, so I went gung ho. I taught financial peace. I started maxing out my retirement accounts, and I still um, I I still advocate for that.
Hmm.
Make sure you put money away, make sure you're saving for later. Um, but yeah, I kind of got off when it came to real estate investing because the math there is totally different. It does take discipline and commitment and clarity in order to
Hmm.
be successful. And you need to know how to like manage and weigh your risks, right? So we want to talk about that. We want to break into the numbers. We want to talk about, when is it good to borrow? When is it not a good idea? Um, and how should we, you got to respect it, right? You got to respect it. So, but is debt dangerous? The question is, if debt is dangerous, why do banks keep lending billions of dollars to real estate investors every year? There's something about real estate investors that banks really like, and they love us, right?
Yes.
So let's jump into this. So number one, why do banks say yes? Why do banks say yes? So if you walked into a bank, you're asking for, you know, 20, 200,000 to flip a house or 2 million to start a business or buy a multifamily. Why is that going to be easier to like buy real estate, or if you want to borrow $2 million to start like a new business?
Yeah.
Which ones do you think the banks are going to be more interested in lending on?
Oh, I think the apartments or the house or the flipper, the real estate investor. And I think primarily it's because real estate can be predictable. I mean,
Hmm.
we can't predict it to the T, right? To the letter, what's going to happen next week, next month, next year. But it is highly predictable. Other businesses may depend on, they need the owner there, right? Like somebody's
Yeah,
gonna start a restaurant or something like that, right? Usually the owner has to be there in the operations, and how good is that owner at what they do,
yeah,
right? It really depends on that person and the team that they build. With real estate, depending on the area, right? You've got tenants, you have predictable expenses, right? It's easy to predict what my insurance is going to be, what my taxes are going to be, what my utilities are going to be, right? You can look at the market. Hey, here's the
hmm,
income that's expected, right? There's so much predictability within real estate that for
yeah,
banks, it seems as a safer bet, right?
right,
That's why they like to lend to real estate investors as opposed to somebody who might be starting, a startup or
yeah,
a restaurant, for instance. Restaurants are just, I think the success rate for restaurant is below 20%.
right.
So
Yeah, in the on the commercial side, we do see a lot of businesses that on paper may be making pretty decent profits, maybe, auto mechanics, we see this a lot in the auto mechanic uh space, um as well as like boutique businesses like hotels and bed and breakfasts. um a lot of times what you find in restaurants are by far like the number one example, because a lot of these smaller businesses, like you said, they're built on a personality. And I think, if I could go back, my first my first serious business was music school. And the first mistake I made with that music school is I called it Lessons with Austin. I didn't know at the time that, man, it's hard to sell that idea, because
mhm.
I'm really trying, I'm putting myself into the equation, right? And a
Right.
bank doesn't want a business, a bank doesn't want to buy Jason's Deli if Jason has to be there the whole time, because you
Right.
can't you can't do so. So what the banks are looking for is they're looking for a business, and real estate investing is a business. You look at it like a business. They're looking for a business that's easy to run when the owner's not there.
Right. Austin, you mentioned something too, is when you said lessons with Austin, you said that may be a tough sell for the bank, right?
Yeah.
What the bank is also seeing is, well, if we have to sell this business, it's
Hmm.
going to be a tough sell to someone else, right? As opposed to real estate. The real estate, like a house or a fourplex or an industrial complex or something, is easier to sell to another investor.
Exactly.
For the same reasons why banks lend on that, right?
Yeah.
The predictability, and there's not this person, this one individual that has to run it, right? Like your music lessons business or
Yeah.
restaurant, for instance.
Yeah,
Yeah.
exactly. So that's first of mine, and that's one of the reasons why there is a lot of money available in the real estate investing world, because banks, they know the game.
Mm-hmm.
If you have a unique business where you're baking these unique cookies or making these unique balloon animals, like, the banks just don't want to touch that because they don't have to deal with something that's unique like
Right.
that. But taking over a fourplex, most investors know how to handle that. So let's look at number two. So loan type. So no, I think we agree. You and I, the same page. That's not inherently good. It's not inherently bad. It just depends on the risk factor and what you're doing with that debt. I'm not an advocate for consumer debt, credit card debt, or anything like that at all. But
Right.
for real estate, it's leverage, it's opportunity leverage. So what kind of property do you think traditional banks, what are they what are they wanting to finance? Like, what do they like and what do they don't like? We're in a volatile market right now. There's still some properties that banks are happy to lend on, and there's some, especially in commercial, there's some stuff that banks are just staying away from. What do you think banks like to lend on? What type of real estate?
Well, I mean, I think real estate that has more than one tenant.
Yeah,
I think one, right, is whether that's an apartment complex or it could be a business park, right, or a strip center, where you have multiple tenants, right? Because then it's like, okay, great, I can deal with some vacancy and still pay the mortgage, still pay that note. And so I think, and again, we go back to that predictable income, right?
hmm,
They probably look at the experience of the borrower as well.
yeah,
If you've never been in commercial and you've done a few flips and now you want to go build a commercial strip center, it may be a little harder to get that loan, right?
yeah,
Unless maybe you have, and then we lean on our partners, right? We lean on our partners who might have that experience to do deals like that. But banks like that, again, they like that predictability. They like to see a proven track record with their investors. They're going to lend to them a little bit more easier.
yeah, 100%. So they want to see that that property is going to make money, even if the owner's not there. I'm going to share my screen. I'm going to show you
Yeah.
my commercial deal calculator. So, you know, in this if you're interested in this calculator, let me know. I can share this with you. But what
Hmm.
the banks are looking for is this. There's a number I'm going to show you right here is the DSCR. So let's say we pull up 123 Main, and 123 Main is a $1 million asset. So we know that it's $1 million. So we're going to be looking for something that's at least an 8 cap. So first of all, I'm going to put 20% down. So that cap rate, the cap rate is a measurement of the profit that that business is generating on an annual basis
Hmm.
before you pay the debt. So your net operating income. So it's typical that something that, let's say $80,000, that's going to be an 8% cap rate. Okay. So this is before we factor debt into the equation.
Okay.
Now, if you buy this with 20% down and interest rate, you know, let's say it's at 7.25. So commercial is typically going to be a little bit higher than residential, but you're putting 20% down. You're going to amortize this over a 25-year period. You have a cap rate of 8%. What I'm looking right here is your cash on cash return. The difference
Hmm.
between cash on cash return and your profit, your net operating income. This is your return after you pay your debt service.
Got it.
So you're generating $80,000 in income off of $1 million purchase. That's an 8% cap rate. That's your net operating income. But your cash flow amount, you're actually cash flowing 10,000 because you're paying a debt of 69,000.
Hmm.
So you're taking that profit. So you have a loan amount of 800,000. You put 200 down, you bought $1 million. You're taking that monthly profit, that 80,000 a year, and then you've got to pay this mortgage,
Hmm.
69,000. So when you take your $80,000 profit and you pay your $69,000 mortgage, you're actually only putting $10,000 in your pocket. That's your cash on cash return. Well, that's where we get DSCR. And this is one of the most important metrics. And I want to make sure that we hit this. I want to make sure that people understand this. This basically says based on the operating income that I'm generating, for every dollar, that's the one, for every dollar that I'm paying on my mortgage, I have 15 cents left over.
Okay. Yep.
So for every dollar, so our target needs to be more like 1.25 or really 1.35.
Okay.
So right now, this is not working. So what can we do? The first thing we can do is we can adjust the purchase price.
Hmm.
We can negotiate the interest rate. If if we come up on the down payment to 25%, that helps a little bit, by increasing the down payment, but nobody really wants to do that. If you can find a way to get that 7.25 to be more like 6.75, that makes the deal just a half a point of interest. Makes just as
Big
big of a
difference.
difference as coming up 5% on the down payment. I'd rather just
No, no,
borrow.
we can't. I mean, we can't negotiate $100,000 off this. It's been listed for 6 months. I mean, come on.
So, and then if you did, you end up purchasing it for 900, it's still at 80,000. Now my cap rate's closer to 9. My down payment is 20% at 6.75. Now
Yeah,
this
look at
is,
that.
you know, this is where you want to be. This is
Yeah.
this is this is where you want to be.
So we negotiate both ends, right? The purchase price and that interest rate.
Yeah, you got to be able to, if this is why right now every phone call that we get on every commercial listing, they ask, is the seller willing to finance this? Because if the
Mm,
seller can finance it when the banks are at 7.25, the seller can come down to 6.75. That makes the deal work.
hmm.
It's even better if I check interest only and you hold on for it for 2 years, you're going to have a pretty massive cash flow. Now, you're not going to build any equity because you're not paying down the
Right.
mortgage, but you may want to do an interest only for 2 years, and
Hmm.
that can make it, a pretty big difference right there. So, question for you: why do you think banks require so much money down? Why can't they just take 5%, or why can't they just take um, 10%? Why does it have to be 20 to 25%?
Well, I think it's really they want that investor to have some skin in the game. You know, they want that investor to like how committed are you to this deal, investor?
Right.
You know, if you're constantly looking for 100% financing on everything, I mean, and those loan products exist, right?
Hmm.
Obviously, they're much higher rates and, things like that. You have to be more qualified, you have more experience. But when you're putting 20% down or 30% down, right, that bank is
Yep.
only lending 70% LTV. I mean, that most banks would do that almost any day, you
Yeah.
know? And like we just looked at, right, bringing more money down kind of helps your DSCR, right? Because your mortgage payment's a little bit lower.
Yeah.
So there's multiple levers you can pull with your down payment.
Yeah. 100%.
You know?
And it actually lowers some of the risk for the borrower just to have some skin, so they have some equity. It gives
Hmm.
them a little bit of cushion in case things go backwards after purchasing the property. But also think about it from a bank's perspective. If you're going to be the lender on a deal and you're going to lend 100% for an investor, and they're going to make basically infinite percent on their investment because they're putting in zero.
Right.
Um, how you think that guy's going to pose a greater risk or a lower risk than somebody that's putting 30% down? Now they're putting a big chunk. They're right.
Well, it's a greater risk, for the person that, I mean, the bank sees the person that's not putting any money on the table as a greater risk because it's easier for that person to just walk away.
Yeah.
If you have somebody who's putting 20, 30% down of their own money in there, then you're like they're gonna fight tooth and nail to keep that project going to be profitable, right? To make their money
Yeah.
back, or to get to a point where they can get their money out. They're gonna be fighting tooth and nail to increase the efficiency, right? To
Yep.
lower expenses. They're going to be doing a whole bunch of things to increase the value of that property, which, gets you better tenants, gets you higher rents, gets you more
That's right.
income, all those things.
That's right. So let's talk about balloons. Balloons now.
I
So
like balloons. They're
yeah,
expensive though these
yeah,
days.
they can get expensive.
Yeah.
Um, I love being a homeowner, and I want to encourage, if you want to get into real estate investing, buy a house. Like, buy a house that you can live in, because the house that you live in, to me, is just one of the best real estate investments. You get tons of tax breaks, you get your homestead exemption, and you get that 30-year amortization, and you're at a lower interest. Our interest rate right now is like 3.1, 3.2. Now I know market's at like 6.5 right now,
Mhm.
but that interest rate will never go up. So once you get locked into a certain rate, you can always refinance when the rates go down. And I'm talking about, residential homestead, your primary. But that's 30, I get 30 years to pay
Mhm.
that mortgage off. There's mostly good things about that. However, on the commercial side, they may do a 30-year or a 25-year amortization, but they'll have what there's called a balloon payment.
Mm.
So what's a balloon payment? Do you know?
Yeah, yeah. I'm familiar with balloon payments. Really, it's kind of almost exactly how it sounds, right? Is you have this mortgage on this commercial property, like you mentioned before, 20, 25 years. It's amortized over 20 to 25 years to keep your payment lower.
Hmm.
But what the bank does is they want to just reassess the risk of this investment, right?
Yeah.
Every 5, 10 years, sometimes even 7 years, they want to reassess this risk. Have interest rates changed? You know,
Yeah.
in today's market, a lot of these commercial properties loans got into big trouble,
Yep.
because they overpaid for property. um, their business plan did not come to full fruition. And then 5 years later, the banks are now readjusting their interest rates and things were jumping, 2,
Yeah.
3%, right? I think there were commercial loans that were out there for like 5.5%, and now
Yeah.
things were jumping up to 8.5%.
Yep.
And a lot of investors got foreclosed on
Yeah.
because them moving forward with that loan, they would just be so far in the red with their new note that they have,
I'm gonna
So
go back to
they were either being, if they wanted to keep the property, Austin, they were having to they were having to refinance this right with the bank and having to bring a ton of money to the table because
yeah.
number one, their interest rate went up and their property value went down.
Yeah. Uh, It's a mess right now in that world because there are a lot of commercial investors that purchased in 2021, and those balloons are typically with the bank. They're like
Hmm.
5 year balloons. And so what they did is they had a 25 year amortization
Hmm.
at 4.5%. So their monthly payment is like $4,000 on a $900,000 property. So they if they bought a performing asset, if they bought like an 8.9 cap back then, like they're making some money, but now the notes are due and the banks are saying, yeah, you can refinance this, but your interest rate's not 4.5 anymore. Now it's 8.5.
Hmm.
And now that cash flow, I mean, look at the difference. 4.5% over 25 years is at 31, and then you go up to 8.5, and
Yeah, it's a
it's
third.
a third of the income. For a
Mhm.
lot of people, depending on how well their property is or maybe is not performing, now they're in the negative. And a lot of
Hmm.
people are finding that if they refinance, they're in the negative. So now we got a surplus of inventory and we have more coming soon in multifamily, especially that those notes are due. And if they refinance their 4.5 or 5% interest into an 8% loan, it's going to ruin them. Um, so yeah, there's opportunity there. Now, it, I think the important thing to understand is there are risks with loans like that. And I think some people, when you get too optimistic about the market and about their piece of real estate and not having a plan, like you said, like if you're going to do those DSCR loans with a 5 year balloon, what if the interest rate doubles? Like
Mm.
it's kind of hard to imagine being at 6.5% right now in 2026, that in the year 2031, our interest rates will be at 13%. But it's been there before.
Yeah,
It could happen.
yeah.
So what do you do? Well, you may say, well, I'm going to sell. I can guarantee you that if interest rates go up to 13%, you're not going to be able to sell an 8 cap or 9 cap. It's going to be have to be at a 13 or 15 cap in order for it to sell. So, can you get that property
Mm.
performing that well? Can you get the rents up? I think you can if you manage it well and you have a good system. And so, anything else on that? Balloons? Any questions on that?
No, I used to like balloons, but not anymore. Thanks for
Not
that.
anymore. Nah, if you know how to do them now. Now if you're financing them, it could be good too. So SBA loans. So who do you think the SBA loans are designed for? And we've been able to do a few of these in the last year or two.
Yeah. So when I think SBA, I think what, small business, right? Small
Yeah,
business administration. Is that what it means? Loans. I'm
yeah,
not too familiar with SBA loans. I just do know that they're I think primarily meant for business owners, right? Not
hmm,
necessarily, I mean, they could be they're investors, right? But maybe they want to get a like a strip center we talked about, right?
right,
And in that strip center, they're gonna occupy one of the spaces,
yeah,
or maybe they just get a building and they occupy the whole building,
right,
so they need this SBA loan, right? We kind of talked about, well, when I'm getting our conversations mixed up because remember you and I were talking about this commercial lot in Pasadena, and we were talking about, okay, maybe a HVAC company could build a
hmm,
warehouse there, right? They can go get an SBA loan
Yeah.
to do that, you know? Or a law firm, right? Looking for office space or things like that. So that's what I
I
think about SBA loans.
I think this is a great opportunity for small business owners. So some clients that we've worked with, an insurance firm who's going to go in and occupy half the building, they
Hmm.
can use that SBA loan and they can lease out the other half of the building. We've seen this with we saw this with an RV park.
Hmm.
He converted it to a resort, qualified for 10% down SBA loan. SBA loan. That RV park, he actually did a combination between a DSCR loan and an SBA loan. So, but the good thing about the SBA loans is they're it's low down payment. The tricky thing about them is it does require a lot of work. And if you don't have a business plan, you're not going to qualify for an SBA loan unless you have a really compelling business plan.
Hmm.
And then we could talk about bridge loans because in the residential real estate investing space, we call this just hard money.
Yeah.
You know,
Yeah. I'm familiar with hard money.
so Albert knows a lot about hard money, private money too. So your bridge loans, what can you tell us? So what's the difference like in with hard money? What's the difference between hard money and conventional financing in that context?
Well, I think with conventional financing, you have more like guidelines and criteria, right? I'm going to talk about the residential side. So on the conventional loans for like a residential home, there has to be inspections, certain inspections that have to pass, right? The house needs to be inhabitable, right? I think you have to have the floor coverings there, right? You have
Hmm.
to have siding on the house. It has to be protected from the elements. You have to have working electricity and sewer and things like that. With hard money, though, you have to have a structure. Like,
Hmm.
if it's hard money. Now you can get your ground up construction loans, right? Where
Yeah.
you get construction loans, right?
Yeah.
Where you can have a structure or no structure. But I know with hard money, they want, if you're doing a fix and flip, there has to be a structure there. And actually, if you look at the disclosures with a hard money lender, you can't knock the house down. So that's because that's
Oh,
an
really?
entirely different loan, right? That they're going to put you in. But with hard money, the house doesn't need to be inhabitable. You can have a big hole in the roof, right? You can
Yeah.
have a tree growing through the living room. So that's where you get a lot more flexibility. Now, with that flexibility comes more risk,
Hmm.
right? With more risk, what happens next? The interest rate goes up, much higher than like a
Yeah.
conventional loan. Conventional loans, I think we're at 6.5 around that,
Yep.
Austin, right? Hard money, most hard money lenders are about 11%, 12%, depending on your experience. I've seen
Yeah.
some hard money lenders at 9%, but they do have some strict criteria to get
Yeah.
into those particular loan products. And they're lending on the asset. So that's the other big thing too. With conventional loans, they're lending to you, the person, Austin
Yeah.
Jones. They're looking at your W-2, they're looking at your income, your debts, how do you pay your bills, right? They're asking for bank statements,
Hmm.
tax returns. Hard money lender, yes, they do run your credit. They want to make sure you are responsible there, but they're primarily focused on the hard asset. That's like hard
Right.
money.
Yeah.
How is this thing going to perform? What is the potential, right? There's a lot more underwriting going on of the asset instead of the actual borrower,
Yeah.
right?
100%.
That's
So
your
there,
crash course on hard money.
yeah, and there are quite a bit of similarities between the hard money and the bridge loans. Basically, bridge loans pretty much behave in the same way.
Hmm.
For instance, you find a 20 unit apartment complex. Well, that bank's going to ask you what is the NOI, what is the net operating income, and just like I showed you on the calculator, you're going to need to be close to a nine cap most of the time for it to make sense with our current interest rates, because
Hmm.
the banks want to see that 1.35 DSCR, that debt service coverage ratio. Um, if the cap rate's not high enough and you really, really, really want it, you're gonna have to put in more of a down payment to get that debt service lowered. Well, you may be so far off that that's not even an option, because say that 20 unit apartment complex is 40% occupied and you're in a market where it should be 90% occupied. So You go tell the bank, well, it should be 90%, but it's only at 40, so I can get it to 90%. Well, the bank doesn't care. The bank's going to say, sorry, it's not my problem. But there's an opportunity there because you probably can get it to 90%. If the rest of the market's at 90%, this is an underperforming asset. Plus, it needs a new roof. Plus, it needs foundation. Plus, it needs, another $20,000 per unit in work. So what are your options there? And that's where that bridge loan comes in. So the bridge loan is like hard money. It's going to typically be a much shorter term, maybe 2 years, maybe less, and it's going to have a much higher interest rate, like that hard money loan is going to be. Your goal is to take that high interest and pay it off as fast as possible. And the way you pay
Yes.
it off is you do what you said you're going to do. You're going to take that 40% occupancy and you're going to work like heck to get that 40% up to 90%. You're going to replace the roof, you're going to do the paint, you're going to, do the foundation. And then once that property, that asset is performing at an acceptable rate, then you go back to the bank and you're much more likely to qualify for that DSCR loan, right?
Hmm.
So what about, and we'll hit on this, we'll end with seller financing, and then we can go into some deal analysis next week because that's what we do. That's how we learn. So what are you seeing with seller financing? Are you finding that more people are starting to become more open to it? And this could include like sub twos and wraps,
Yeah.
because the sellers are still on the hook for that.
Right. I think people are more open to seller financing. I know I would be on some of our properties, kind of depending on the numbers. Seller financing, when the seller becomes the bank, let's say it's a landlord too, because this is probably one of the best things for tired landlords. They don't necessarily have to sell their property. They can become the bank.
Hmm.
And, you know what that means? There's like no more maintenance, right? They don't have to worry about the roof anymore. They don't have to worry about all these things that were giving them headaches with tenants and collecting rent and evictions and all that. But they sell their finance to another investor. And now that investor, they're responsible for all that, and the same kind of covenants, right, that are in the deed, right? They have to pay their taxes, they have to hold
Hmm.
proper insurance, they have to make sure that the home is habitable and all of these things, right? I think the investor that's now the bank, they go one step further than the bank, right? They're probably still driving by the property, make sure
Yeah.
it hasn't burned down or whatever. You know what I mean? Banks don't typically do that, but they kind of get that true mailbox money,
Right.
Austin. Where it's just like every single month is that ACH deposit, boom, right? And then if it's a sub two, where there's a mortgage still, an underlying mortgage in place, and if they've done it properly, maybe they've got that really good interest rate, that
Yeah.
3%, 3.5%, and they can go then seller finance this to someone, and now they're arbitraging, right?
You're right.
Is their rate is 3.5%, but they're like, hey, I can give you 5% or 5.5%. That's still 1.5% better than you're gonna go get at the bank,
Right.
right?
Yeah.
So now they're making income on top of that mortgage that they're having to pay
Yep.
every month. And the cool thing about having this arbitrage is those numbers will never meet. They'll never cross over, right? As long as your interest rate is above your current interest rate, the underlying
Right.
interest rate. So,
Yeah.
um, yeah, you got tax advantages, right? Because usually for investment properties, you're going to pay capital gains if you go out and
Hmm.
sell the property,
That's
but if
right.
you hold on to it, so you're not really paying capital gains. Um, you can typically get better sales prices, because we always talk about for sale by owner.
Yeah.
Those prices are usually a little bit lower. And you don't have all that paperwork either that
Yep.
banks require, right? So
Yeah.
you can close faster, you know.
You can
So
close
when you pre
faster and you're less likely to have
right,
fallout.
when you present that to a seller, right? Here's this package for you, seller, and you educate that seller, then they may be willing to come to the table as the bank.
Yeah. 100%. All those are, and I think that a lot of sellers that are in a position where they have an underperforming asset, which this
Hmm.
is very common both in the residential and commercial side. The asset's underperforming, but the seller says, well, it's really worth X. And we're
Hmm.
like, I mean, you look at it like when you say that it's worth, $1.5 million or $1.75 million, but it's actually at a two cap or a three cap. Like nobody can get financing on that. And so for a seller, if you're able to provide financing, at least like plan, you're the bank, like give them a bridge loan, give them a 2 year balloon or a 3 year balloon, give the next buyer the time that they need to get the performance of that property up so that it can qualify for a DSCR loan. So we have several of those in place right now where, and it's also contingent on the rates not going up as well.
Mm,
So some of these buyers will like, okay, I'll do a 2 year or 3 year or 5 year, but we're at 6.5 right now. And in 5 years, if the rates go up, like I'm sticking with you, you're going to stay my bank.
yes.
If the rates go down, then I'll refinance it.
Yeah.
And so buyers are getting smart. And sellers are doing this same thing, like not going for that, you
Right.
know what I'm saying? So yeah, the point of just kind of running through that today is these are different tools. You got hammers, you got dangerous power drills, and if you know how to use them, you can make some cool stuff and accomplish some
Hmm.
some big things. If you don't and you're reckless and you don't pay attention, you're going to cut your finger off. And that's what we're trying to prevent people from doing is hurting themselves and creating messes because um, I've got Anna and Caroline on the call. We have clients that have dug themselves into a hole because they weren't paying attention to the terms on their financing, and they were pretty optimistic about things. And unfortunately, in the last 5 years, the market has kind of slowed down a little bit. So,
Yeah.
if you want to have an advantage in this world, understanding these products, whether or not you're going to participate in these products, but understanding them, you're going to meet people that are in a bridge loan and that notes due. You're going to meet people that are on a balloon and the balloons due. Maybe you can help them,
Yeah.
but you can't help them if you don't understand these products,
Right.
right? So, any final words, brother?
Oh man, who's ready for some free pizza?
Yeah. So Thursday night at the Pizza Lounge. This is my favorite happy hour place. I know Anna is ready. We have some great sponsors. So you don't have to pay for your first two drinks on Thursday, and you get all the pizza you can ever dream of. It's pizza heaven
Yes.
on Beltway
Delicious.
8. So bring a friend, bring somebody who's I love the celebration. I love the encouragement.
Yeah. It's
Bring
gonna be fun,
somebody,
man.
come by. And
All right,
until
I
then,
need to find, I'm gonna find somebody to bring this time. I usually just come solo, so I'm gonna find somebody to bring this time.
bring them.
All
Bring them.
right.
We love meeting new people. This is why we do this. All right. Have a great rest of the day.
All right, you too.
Bye.
Bye.